Hi, my name is Michael Joyce with JoycePayne Partners, and thank you for watching our video where we're going to talk about some of our thoughts and viewpoints for the spring of 2017. As I'm recording this video, things have been pretty good over the past year, and some people think maybe things have been a little bit too good, and there's a lot of trepidation in going forward in the markets and how things will look. And things indeed have been pretty good. And I will say directly that we think that there's a very good chance, in fact maybe it's probable, that we're going to have a correction in the markets at some point. Don't know what would be the catalyst for this correction, don't really know the timing of the correction, but indeed there probably will be a correction. But we don't think it's going to be the beginning of a bear market. I mean, if we think about it, the economy coming into 2017 was in pretty decent shape. And if anything, it's had greater momentum as the year's gone on. The labor markets in the United States have been pretty tight, and that's led to some real wage increases. And that combined with still low energy prices means that consumers have a lot of discretionary personal income that they can use for spending. And in fact, surveys have shown that consumer sentiment is at multi-year highs, investor sentiment is at multi-year highs, and that's all good for the economy. What had not been very good prior to this year had been business investment. But now we're hearing anecdotally, at least, that things are picking up in that area as well. We've talked to bankers that have said that small business lending has really been on the rise. So if businesses, particularly small businesses, are putting money back into the companies, they're buying more equipment, they're building plants, they're building warehouses, they're investing in human capital. That's very good for the economy and will cause greater economic growth, which in turn would mean that corporate earnings will continue to go up over that period of time. So if we do have a correction, it's probably something that we would just ride through. It's not something that we would advocate trying to time. In our recent quarterly commentary, I wrote about a client, a longtime client, somebody that we worked with since 1995, and most of his financial assets are in his IRA. And as I was preparing for this meeting, I noted that since 1995, the value of his assets in his IRA account have doubled. And not only that, but over those years, he's taken distributions from this IRA that are equal to at least double the balance of what it was in 1995. And I think that's real testament to staying in the game, to not trying to worry about the ups and downs that are going to occur in the market in the short term. Certainly there have been times with that client that we've gotten defensive. The summer and fall of 2008 come to mind, but I think if you try not to worry about when the next correction is going to come and try to time it and be out of the markets at that time, that's going to be the important thing. If there is going to be a downturn in the economy or a bear market coming up, we will attempt to be defensive at that point in time. So what do we worry about? Well, the biggest thing that we're worried about right now is that interest rates go up more than what is expected. And right now in the markets, there are a couple of interest rate increases that the Fed will contemplate that are already priced into the market. So that's not the part we're worried about. The part that we're worried about is if interest rates go up more than what's currently priced into the market. So that could be, what if wage inflation picks up more than expected? So inflation picks up and interest rates then pick up. That's not going to be a good scenario for a lot of the asset classes that we're invested in and other people are invested in. Certainly long-term bonds, which tend to be more interest rate sensitive, would not perform well in that type of scenario. Stocks would also struggle because if you think about it, one of the reasons that the stock market has done well is that low interest rates have underpinned that. But if super safe bonds have higher yields, that may be less incentive to invest in dividend-producing stocks. At the beginning of October of last year, the dividend yield on the S&P 500 was about 0.7% above the yield on a 10-year Treasury note. Now, the yield on a 10-year Treasury note is about 0.4% higher than the dividend yield on the S&P 500. If that differential reaches 1% or 1.5%, it's certainly plausible that investors will sell some of their stocks and buy some bonds. And the catalyst for higher interest rates would be unexpected increases in inflation or some exogenous event that could happen. International markets are also doing well right now. In fact, the emerging market indices are the best performing asset class so far this year. And I think that's reflective of the fact that not only is the economy doing better in the United States, but the economy is doing better worldwide. And we're going to be investing in international markets because we think it's good to be invested across multiple markets and diversify. We think that's the best way to produce long-term superior risk-adjusted returns. Changing gears a little bit, right now we're in a season that everybody loves, and that's tax season. And one of the things that you should be looking at as you're filing your tax returns this time of year is how much you're getting back in your refund. A lot of people like getting big refunds back, but I'm here to tell you that getting a refund back is not necessarily a good thing. Because that means that you've earned 0% on that money. You've basically given the U.S. government a interest-free loan for that period of time. And you don't want to pay a lot at tax time either. So I would encourage you to talk to your financial strategist and look at the proper amount of withholdings you should have and the proper amount of quarterly estimated tax payments that you should make to make that differential between what you might pay in or what you might get back very close to your actual tax liability. Now, if you are getting a big tax refund, what should you do with it? Well, you might be looking at maybe doing some deferred spending with that, but I would say that if you have any kind of debt that we call bad debt, credit card debt, or maybe debt on an auto loan, or debt on any kind of depreciating asset, maybe what you should do instead of doing some deferred spending is pay down on some of those credit card balances, pay down on the auto loan, and do that with your tax refund. So I've been very pleased to share with you some of our thoughts and viewpoints for the spring of 2017. If you have any other questions, please contact your financial strategist at JoycePayne Partners. And if you want to see some of our more recent thinking, visit our website at www.JoycePaynePartners or follow us on Twitter at JoycePaynePTRS. Thank you.